Wow, what a run for the markets, right? If you're an investor, you're probably feeling pretty good about your gains. But here's the question that should be on your mind. How do you actually protect all of it? Today, we are going to break down a small but mighty strategy that's designed to do just that.
It's so easy to get comfortable when everything is green. But if market history has taught us anything, it's that what goes up can come crashing down, and it usually happens way faster than you'd think. So the real question is, are you ready for that moment?
Well, it turns out there's a tool that a lot of professional investors use, kind of like an insurance policy against a market disaster. It's sort of an unlikely hero in a portfolio, and it's actually way more accessible than you might think. So, what exactly is this investor's insurance? To really get the strategy, we first got to understand the tool that's at the very heart of it all. Okay, so this is a put option. Now, I want you to really focus on that phrase, the right but not the obligation. It's kind of like putting a deposit on a house, right? You lock in the price, which gives you the right to buy it, but if you find a better place down the street, you're not obligated to follow through. A put option does the same thing, but for selling. You're locking in a selling price. That flexibility, that's its secret weapon. You are literally buying a choice. The easiest way to get your head around a put is to just compare it to its total opposite, which is a call option. A call is a bet that a stock's price is going to go up. A put is a bet that it's going to go down. Simple as that. One's for the bulls, the other's for the bears. And today, we're focusing on the bear side as our insurance policy. All right, so now we know what a put is. Let's get into the good stuff. The three small but mighty ways you can actually use it to protect your portfolio.
Okay, first and foremost, as straight-up portfolio insurance. The idea is you spend a tiny fraction of your portfolio, we're talking like 1 to 2%, on these puts. Now, in a normal, healthy, rising market, that cost is just like paying your premium for car insurance. You hope you never have to use it. But if disaster strikes, I'm talking a sudden market crash, these little options can absolutely explode in value, cushioning the blow to your main investments.
Use number two, it can be like a sniper's tool. So imagine you're still pretty bullish on the market overall, but maybe there's one specific company or sector that's just giving you a bad feeling. Instead of selling off all your winners, you can place a very small, targeted bet against just that one area using puts. You get to stay in the game while surgically hedging against a risk you're worried about. And number three is what the pros call a tail risk hedge. Honestly, this is the very soul of the small but mighty strategy. Professionals will consistently, year after year, set aside a tiny percentage of their portfolio for these puts. Now look, 99% of the time, it's just a small, manageable cost of doing business. But that other 1% of the time, the black swan event, the crash that nobody sees coming, that tiny position can be the one thing that saves the entire portfolio from getting completely wiped out. Now, theory is one thing, but seeing it in action, that's something else entirely. It's really fascinating to see how this strategy plays out during a real crisis. So let's all just travel back to March of 2020. The world was grinding to a halt, and the market just went into an absolute freefall. The S&P 500 ETF SPY, it just plummeted, down about 34% in less than a month. Panic was absolutely everywhere. Portfolios were getting demolished. But for the folks who held these small put positions, it was a totally different story. Puts that cost maybe a few $100s back in January, they exploded in value. We're talking rocketing up to over $10,000 by the middle of March. I mean, just let that sink in for a second. That's a staggering 2,000 to 3,000% return. A tiny insurance premium turned into a massive portfolio-saving windfall. And hey, this wasn't some one-off fluke. Just look at Tesla back in 2022. After this massive run-up, the stock had a brutal decline. Investors who had bought puts with strike prices, that's just the price they locked in to sell at, way down at, say, 300 or 250 bucks, well, they were rewarded big time as the stock crashed way below those levels. So, how big was the reward? They saw returns of 20 to 70 times their initial investment. It's the same story again. A small, calculated risk produced an absolutely enormous portfolio-saving reward. So here's the crucial point to all of this. It's not really about trying to perfectly time the market. It's about building a specific advantage right into your portfolio. This table just lays out that asymmetric advantage perfectly. So look, in the first scenario, a continued bull market, these puts just slowly lose value. It's a small drag, maybe 1 to 3% on your portfolio. That's your insurance premium, right? In the middle, a mild pullback, they might gain a little, you basically break even.
But now, look at that bottom row. In a sharp crash, they can explode 10 to 100 times in value, providing huge protection. The downside is tiny, and you know exactly what it is. The potential upside is just massive. This right here, these are the magic words. Asymmetric upside. You are risking a little for the potential to gain a whole lot. In good times, when everything's calm, this insurance is cheap, but it gives you this incredible outsized protection at the exact moment you need it most, when the tide suddenly and violently turns against you. I think this quote just nails it perfectly. Look, this isn't about being a pessimist. It's about being a prepared realist. You're buying peace of mind and a really powerful defense against the storm. So the final question is pretty simple. Is your portfolio insured?